Well, hello everyone. Don Garman here again, August 2026, with our usual pal Jackson Vickers attending and a new face, Chris Connolly. You can wave, but we will tell you more about Chris here shortly. Um, you might notice that we are a week delayed from our usual time that we try to get something out to you, which is generally the first Tuesday of every month. The reason we delayed was specific because you might have noticed it has certainly been commented on by a few of you via text to me that the last part of last week was a particularly prosperous period for us and our clients. And so, the reason we kicked it off is we had, kind of um, the main event of this quarterly earnings season for the end of last week. And these are becoming increasingly crucial tests to pass because you're probably aware that we're in a era of enhanced capital investment is how they would phrase it, capital spending, which is soaking up great amounts of cash and capital of these large mammoth dinosaurs roaming the earth companies that we all use as part of our daily lives. And so the natural question is, how are the businesses going to continue to supply or support this level of spending? And so these are the topics that come up in these calls. So um, I'm not going to get into too much depth on that. And before Jackson, I get your thoughts on the current uh, market environment. I have, of course, my own, which I will share here in a minute. I thought I would take a more general, make a more general point about why this has been such a uh, comfortable, seemingly tailwinded environment for equity prices amidst generally pretty dire news. Iran war, tariffs, some might refer to the White House approach as chaotic. Um, so I certainly feel that way. It's hard to understand from day to day which way we're lurching with whatever approach we're putting forward. So I think largely the market has tuned out all of that and has focused more on the chart that I think Daniel might put up here, which is this has been a recurring theme in these videos now for years and years and years. And what do we listen to in terms of signal to determine how to position strategies relative to more risk or less risk? So, if you've been around for 20 years, and many of you have, you remember that 08, 09 period where year on year earnings estimates started declining. And that was an important moment to recognize that something was changing underneath the surface that required evasive action. So let me decode that and make it a little more simple. So analysts in the world that are focusing their attention on any number of companies that they follow, 2, 5, 10, maybe not more than 10. You can't follow that many companies that closely. You're building models to predict how much money those companies will earn into the future or in the future. And if you add up all those estimates, you come up with some consensus estimate, the sum total of all of their wisdom about what these companies will earn in the future. And prices generally will follow rising estimates. In other words, companies are doing better than the models might have predicted, and therefore prices will tend to stay stable and rise. And so that has been kind of our lighthouse over the years of staying the course through some challenging, turbulent waters. So the simple point I would want to make is if you look at the 2021 or 2022 estimate for earnings, actually, if you look at the actual in 2021, it came in at $202.20. So just think about a $200, it's $200 worth of anything And the estimate for earnings in 2027, 6 years later, is $402. So in essence, earnings are expected to double over a 6-year period, which is extraordinary in terms of earnings growth. So we can strip away a lot of the jargon and the dynamics around that. And if that is what ends up happening, then we're in a fairly good place. And so, Jackson, the one question I will ask you, and then I will have my answer, which is, what do you think would be the curveball that hits this market in the stomach that we're not expecting? Let's say between now and the end of the year, what do you think is the tell?
Yeah, really good question. I'm gonna give two kind of half answers to make up my one full answer, which is oil prices remaining elevated. That has to get baked in eventually, and I think it has to get baked in at a much larger scale than it currently is. That'll affect consumer discretionary spending. That'll affect the price of consumer staples, which will have to be spent on, and it'll affect energy workloads and everything that contributes to our economy. The second thing actually has to do with the NVIDIA announcement that came out that I'm sure everybody's read, but quite simply, it's a wager on the depreciation cycle of GPUs and whether you can lend with those as collateral. And so I think if at the model layer and the workflow layer, if those accelerate fast enough to where the GPUs do have to be depreciated more quickly, then now we have an earnings overestimate for a lot of the compute hyperscalers and then the hardware companies, which would mean we'd have to reprice all of those businesses. And so that would be something, I don't know if that's going to get solved in the next 6 months, but if the models continue to accelerate like this, maybe we'll have some idea before the end of the year.
That's interesting. Good observations. We have not chatted about that before, so that was good and new information to me. So I will give you my tell, which I think is somewhat related to your first half point, if that's how we're crediting your first comment. Um, so the yield on the 30-year Treasury hit a 19-year high today. So prices, the yield, in other words, what you receive if you are willing to loan your money to the government for a 30-year period, hit its highest point since '07. Why do I think this is important? So simply speaking, as we approach $40 trillion of federal debt, which is even still an understatement to what our actual obligations are, in the last 2 years, we've lowered the Fed funds rate, the very shortest end of the curve, 175 basis points, 1.75%, lowered it. And yet the 30-year yield has gone up to its highest rate in 19 years. Super steepening of the curve. So what that is suggesting is that the inflation that the Federal Reserve Board has proclaimed they will tame, the market is believing that there are some other dynamics in place. Could be oil prices, as you point out, could be that and other things that will make higher inflation for longer a permanent part of our lives. That's a big problem for markets if that actually turns out to be a sustained, observable, measurable phenomenon. And it will mean the Fed will be hiking rates, not cutting rates, obviously counter to what the president would prefer. And it will ripple again through the least prepared in our society to handle it, which they've already been, underneath the train for several years now. And that hopefully will turn in their favor. But if the yield on the 30-year Treasury keeps rising, we will start taking risk off well in advance of when prices are recognizing that. And so that's kind of the, I don't even love this term, but canary in the coal mine for us, which is if yields are persistently rising, that's going to be our signal to take risk off. And so on the flip side of that, at the present moment, the bets that we've made, if we call them that, the investments that we made in these businesses, we've largely chosen the right ponies to bet on through this period. And well, one of the secrets to our long-term success has been not taking these massive beatings that even people in good subsets of the market who've done well for some period of time, those when those turn as they did in this really popular group of stocks in July, they got hammered for a good long while, and we sidestepped the entire, as I refer to it, bar fight. So sidestepping bar fights is good business if you like to sleep at night as I do. So, Jackson, we'll leave it on the market stuff there if you don't mind, and I will introduce our new friend over here. I don't know what side the video will be on. So before I get to letting Chris talk a little bit about what he's doing for us, I want to introduce him on a personal level to all of you. He's a new face to some of you, not to many of us around here. But I've known Chris for over 20 years for sure. When I met Chris, he was, barely a teenager probably. And our families go back together certainly more than 40 years. My dad knew Chris's grandfather, as I did know Chris's grandfather. I'm very good friends with Chris's dad. I've had the privilege of watching Chris grow from a curious, astute student of specifically real estate markets, and that takes a lot of dimensions in Chris's background. He's worked in mortgages, he's worked in multifamily, he's done development. He's really kind of had he's had his education across the spectrum of the real estate world. And a couple of years ago, as I've alluded to in these videos, this was becoming a real need for our clients. And so it was a solution that we needed to address on their behalf. And I can think of no better person from a character perspective than Chris Connolly to come join us in working on these problems for our clients. So Chris, you and I haven't even really talked about this. I've just noticed you are pretty busy and you've gotten a lot busier. So what I would love for you to share with your new friends who watch these videos is, what are you seeing along the real estate marketplace? What pain points are you solving for people, and how are we addressing these solutions to help make our clients' lives better? So without further ado, I'll toss it to you, Chris, and we'll go from there.
Cool. Thank you, Don. Well, what we're seeing a lot is that, especially in our area, that values of real estate have just appreciated so much, while rents have kind of lagged a little bit behind that growth. And so what it's created now is a situation where, values could be, pretty extraordinary, where the market rent is, in some cases that we're seeing, 2% of the current value. And so you layer on top of that all of the difficulty of managing tenants, and how litigious our society is. And so what we're seeing a lot is people opting out of that active management and transitioning through the 1031 exchange into the DSTs, or the Delaware Statutory Trust, which again is just the passive institutional real estate that we're able to coordinate here. And so really just, we're the success stories, it seems like we're adding more and more every month with, an increase of income able to pay for private education, or just, an increased cash flow that improves our clients' lifestyle. So yeah, and I would say that right now is probably the best in terms of optionality. We've got self-storage, multifamily, senior living, student housing, triple net essential retail. It's really we're in a really good place right now.
Okay, so let's get granular a little bit on this, which is okay. So let's say over the course of the last 25 years, our family has accumulated six pieces of income producing real estate, or rental real estate of some variety. I don't know if it's good or bad. What do I do?
Yeah, so that would be a great opportunity for us just to analyze the numbers really, right? A lot of people haven't seen what the value of their real estate actually is, and maybe they've had a tenant in there for 10 years and oh, they're great, and we've never really increased the rent, right? And so we could look at it, we run the numbers after all their expenses, and it's like, man, this investment's yielding you 1.8% of its current value. And so it's like, okay, well, we can easily, more than double that in a DST and remove all the management responsibilities. So in those situations, it's productive to look at, okay, well, what are, if there's six, what are the one or two worst performers of the bunch, and starting with that.
Yeah, I think that's well said. I think the way we've explained it, or I've heard you explain it, is there are certain assets that are sort of core to what a family would like to own and what really matter to them. They were purchased in a location or have a profile that it's performing very well. Well, that's really not what we're talking about. It's the fourth, fifth, and sixth ones that are kind of the afterthought properties that everyone's just in too much of a hurry to want to sit and deal with. Um, I think it's safe to say you've really relieved a lot of pressure of as people have gotten older and, as you point out, more litigious and not wanting to fight these battles of raising rents or losing a tenant and going to get a new one, or heaven forbid somebody slips on something in the driveway and there's lawsuits flying around the joint. And so anyway, there's a whole host of issues that people are looking to kind of uncoil themselves from the most unpleasant parts of being a landlord.
Yeah,
Is that a way
absolutely.
to say it?
100%.
Chris, I have a real quick question for you,
Yeah.
which is how common is it for these income producing properties to be underperforming inflation? It kind of tying into what Don just said. Inflation's well above 3% again, noticeably. So are you seeing a lot of properties that are underperforming inflation?
I would say when it comes to single family homes specifically, almost always, right? And when we run the numbers, it's, rarely will you see a yield on current value that's over 2.5, 3%. So that's
Wow.
basically, right there. And that's assuming that we're at market rent,
Mhm.
right? So a lot of these situations we've seen again are, they've been there for forever. We don't want to increase the rent. They never call, but it's like, man, well, if you look at it from an investment standpoint, it's almost dead money at that point.
Mhm.
Wow. Okay.
Yeah, we hear that from time to time, oh, we love that tenant and, she's so nice. And, it's like, well, we haven't raised the rent in 10 years. And it's like, they hold us to a much different standard in terms of their investments than they do the nice lady who's been in their property for 10 years. Um,
For sure.
so I would say if clients have questions, my endorsement is there is no more principled person of character than Chris. I wouldn't have him here if I didn't believe that to the core of my being. So if you have a question about a piece of real estate that you own or your friends own or somebody owns and you would like to talk about what your options are, this is I would say, exploding category here at Mirador. And I think Chris is going to be a very busy guy. What I love about it is it really is solving a genuine problem that our clients have. And so that's always the best place to start. So, Chris, thank you for joining us on this little chit chat. Jackson, thank you for everything. You've been doing a great job this year. As you know, we have a friendly competition between our two strategies, and I noticed you're back ahead. You've taken charge as let's see, we're in the mid-August corridor. So what are we? Somewhere around the back turn.
Yeah.
We're not quite around the third turn yet, but we're on the back stretch for sure.
It's been
So
an
I'm
important 2 weeks for me.
it has indeed. We tease each other in a fun way because I know what certain positions I own that he doesn't own that have been fortuitous for me, and I know what positions he owns that I don't own. And so some one of these days we'll sync up and but if we just owned the same stuff, we might as well just have the same strategy. So there's what fun is
True.
that?
It's true.
So anyway, to you guys who watch these on a regular basis, we appreciate you as always. What I said a couple months ago is we do have some new faces around the firm. There will be more people joining us as we go through time. I'd like to really make sure that those of you where when we have a discussion and I hear, "Oh, I didn't know you did that," that's on me for being a poor communicator of the capabilities that we've been surrounding you with at our firm. So on that note, happy late-ish summer, and I noticed the darkness is extending a little longer in the mornings now. And Chris, before you know it, we'll be running around our backyard in the dark as we were, at mid-September, late September last year. But I'll be. I was laughing, not to digress, but somebody said, "Oh, do you have to work out?" And the sidebar is, it's my 56th birthday on Thursday, and I said, "No, I get to work out because there's a lot of people that don't have the ability for whatever reason to do it, and I think there's somewhat of a duty at this tender age to keep on trucking, which you are super helpful in that regard as well, buddy, including this morning. That was a ton of fun." So on that note, we'll see you guys all in September, probably first Tuesday, unless there's a reason to delay it, but we'll leave it there and see you later. Bye-bye.
All right.